Welcome to a community built of tomorrow's business leaders. Hey guys, I'm William Freitas, and this is the Socius Podcast. Socius, welcome back to another episode. Today we've got Steve Mitchell from Nexus Advisory. Steve, welcome to the show.
Thanks for having me, Will.
Tell us a little bit about what you do, mate, and what has you be where you are today.
So Nexus Advisory, we are a growth debt advisory. So we basically structure tailored finance solutions to businesses, helping them unlock growth and basically achieve what they need to achieve in business and their business goals via funding solutions and different avenues, whether it's debt or equity. How did I get there, did you say?
Yeah.
Bit of a funny route. So I actually started in finance originally. So I studied economics and a finance degree at university, kind of left there, went out into my own businesses, had some gyms, had a couple of startups, exited from the gym, sold them. A couple of the startups that I had, unfortunately, didn't go the way I'd planned. I wish I knew someone like myself back then. And then, I found myself back in the finance world. So I came kind of a full 360 and I was only in there for a few months when I quickly realised that, this is what I really enjoy doing. All right, so it's essentially helping different businesses. You're meeting a lot of people. I'm a real people person, so I love that aspect of the business, that kind of natural network effect that it creates.
Yeah.
It's been an 8-year journey, and here we are.
So let's jump into it, right? Growth debt. Not a lot of people view debt in that sense, right? It's a real mindset thing. And you've sort of, from the back, we'll dive into a bit of your background, but tell us why, I guess, the startups, why didn't they work out, and why is it that you say that you wish you knew someone like yourself right now? So
the startups, one of them, I was a little bit ahead of my time in a couple of the areas. So one of them was a genetic test. So basically we're giving you a report to your predisposition to lifestyle diseases. So that was the end goal with that. But to get there, we wanted to commercialize the product. So, one of the most kind of commercial, fluid kind of businesses around is fitness, right? So we could do a genetic test on your fitness genomics and also your nutritional genomics. So we could basically give people training programs based on their predisposition to whether it's explosive training, VO2 max training, whatever that is. So did that for about 2-3 years, went to India. I found a little bit of a back door to get testing done in Australia. So you can't officially do the testing in Australia. You need to be TGA qualified to have a genetic testing lab here. But I could ship people's saliva overseas, get it tested, all the bioinformatics done there, and then they could send me the data and then I could put that into a report.
Right.
Yeah.
Okay.
So, that was kind of 2012, 2013, 2014. I kind of did that, yeah.
And you're saying before your time because the idea that you had was probably a little bit before the market was ready.
Yeah, and it still is. It looks like. I don't know if you keep up to date with any of that, but 23andMe, which is the largest kind of genetic testing company in the world, they were bought by Google or acquired by Google, I think, back around 2013. They just went into administration. They just folded essentially. Yeah. I think what it is now is people now they understand, giving your DNA away, right? So what's going to happen with that? And it's forming part of the court case over there about what happens with all that data, people's data. And so give us a little bit about, because you said, had you known a Steve Mitchell back then, things might have worked a little bit differently. Tell us why. Yeah, I think a couple of key reasons. One is I was using my own funds to float the business. So I thought I had to fund everything. I had to start a business, a bit like, traditional bootstrap startup. So I thought that's what you have to do. I had no idea about equity. I had no idea about having early investors, angel investors. I had no idea that, you could get debt based on revenue, not just profit. So I thought I had to have a business that was profitable, making profit from day one, for it to work essentially. So I sunk a fair bit of my own capital into that business. But if I knew what I knew now, I wouldn't even done anything to do. I wouldn't have done any of the report at all. I wouldn't have spent any money in design or in the bioinformatics research side of it. I would have left all that to the Indian team, and I would have just focused here on raising some capital to try and get out to as many people as we can essentially.
And I guess what we're going to do hopefully in this episode is flesh out what growth debt looks like, if that's the term that we run with.
Yep.
But effectively, what it is that you do, because I think there are so many business owners who listen to this podcast who might think, how is it that I can grow my business? And a lot of them will think exactly like what you just mentioned. I've got to use my own capital. I've got to, whether they're in e-commerce or whatever it might be, I've got to pay for all the samples to come through. I've got to do all the production. I've got to do all the marketing, and then I've got to hopefully one day make a profit. But what it sounds like too, what you could have done with some benefit of is the network.
Yeah.
The experience and the knowledge, which is what you bring. So tell us a little bit more about that, and I guess potentially even the type of clients that you work with and how it is that your journey would have been different in the past had they been working with you.
Yeah, I think so. Back to that kind of at the startup stage of a business. I mean, most people, again, will think, I need revenue in, I need profit, or, they're way too early and they try and go to these venture capital funds and try and raise money that way. Whereas essentially you probably want to go first off, if it is like a tech or it's a kind of a startup based business, maybe not trades and services, but you probably want to go to your kind of close immediate network first, raise some small amounts of money there, test a minimum viable product. I mean, this day and age, you really want to test the market with marketing, and that's going to be your main goal with it. The product is almost irrelevant compared to how good your marketing team is and your content engine. Most of the clients that I would see would be start up to kind of that 50 mil rev stage. Sweet spot probably 5 to 20 mil rev.
Okay.
And those kind of businesses are really on that growth trajectory. So they're either, not profitable enough for big banks for the kind of lending they need, or they're not quite ready for equity. They're still a bit founder-led. They don't really have the whole structure in place, governance, etc. So, if the founder was out of the business essentially would stop. So they're kind of some of the key things that we help certain businesses try and change and develop as well. So, even though we arrange debt predominantly, we do some equity. We really try and help advise them on what they need to do to get to that next level as well.
Yeah, and as I mentioned earlier, some of the listeners will have a very basic finance knowledge. So let's break down what equity is for them and the type of debt that you get involved in as well, if you can.
Yeah.
Give us a little bit of a rundown.
Snapshot. Yeah, so equity, which is probably going to be your most expensive, inverted commas, form of money. So essentially giving shares or portion of the business away to someone else, which eventually upon an exit should be worth X amount more. Then you've got different forms of debt. So you've got, venture debt, which is essentially a tax on to equity. So most venture debt providers won't give you debt unless there is an equity or equity investors in play. Typically they would probably prefer a bigger fund as well. It just gives them a bit more comfort knowing that if things did turn a bit pear-shaped, there's probably people with a bit of skin in the game that they could knock on the door to and say, they need some more money here and they can top it up. And then after that, you kind of got a lot more of your traditional debt pieces. So working capital, trade finance, M&A finance, things like that.
Yeah, and on the equity piece, in some instances, you'll have those investors sitting on the board as well.
Yeah. Predominantly, they want a board seat. They want certain covenants in play as well. A lot of the private credit funds, which is like your large debt pieces, that kind of 3 mil up, they will put a lot of covenants in place on the financials as well. They want EBITs at a certain level, debts at a certain level. You need to maintain certain ratios.
Which comes with its own set of challenges, right?
Yeah, definitely, yeah.
Which in some instances you could say is a significant benefit in the sense that I find a lot of business owners have zero accountability, right? And having some outside debt can add a bit of accountability that can help the business be propelled forward.
Yeah.
But in some instances, it can be pressure that's not necessarily required. Would you agree with that?
Yeah, I mean, there's a lot of bad debt out there, using, long-term debt for short-term working capital, or vice versa. I've seen people take out 3 to 6 month term loans for, expanding into new facilities, where it should have really been a 5 to 10 year term loan with a major banker, however that looks. So you really got to find the right kind of debt to enable you to grow as well.
So then just to simplify it too, when a business can't get, funding from a bank, which often, from my understanding, you correct me if I'm wrong, banks generally lend on profitability. Whereas you're providing an alternative outside of that, right? So what does that generally look like?
Yeah, so banks will typically lend against profitability or cash flows. Over certain levels, they probably want security. Typically, all of them will want personal guarantees as well. Where in, some of the lenders that I work with, we can structure it differently. No property security. There could be a path to profitability. So you may not be profitable yet, but if you've got good forecasts, good trajectory, and you can model that out, with three-way forecasts, then there's lenders that will lend to that. And then there's lenders that won't take personal guarantees as well. So some businesses out there have, a number of shareholders. You may be a director, but only be worth, only own 15, 20%. You've got to personally guarantee the debt with major banks for sure.
And these are tier 2 lenders and the like that the general public don't have access to. Is that correct?
Yeah, they just wouldn't know, or they wouldn't have access to. They can Google and do a cash flow working capital search, and there'll be 4 or 5 lenders out there which maybe on the radio or TV that people will know. But again, they're a certain type of lender for a certain type of funding requirement, whereas some of these more strategic financiers, typically you don't know about. Even some of them I'm still discovering some of them myself.
Yeah,
and it's the market's adapting and changing. I think in the next 5 to 10 years, the word credit fund, even SMEs, you'll hear about it all the time, because our major banks just are not interested in supporting SMEs. They just want to do residential backed security. They're not interested in doing business loans.
Yeah.
It's not something that they want to do.
And it completely changes the ecosystem for small business, right, I find, which it's kind of great. It's an exciting time for you, and I guess the evolution of credit funds for sure. But in terms of, let's talk about growth, because I'm really interested to know how businesses can use debt to focus on growth.
Yep.
What are some great examples that you've seen that you work with on a daily basis that businesses have used debt to propel growth?
Yeah. A key one is probably supply chain or trade finance. So being able to forward pay for stock without using cash off the balance sheet. So essentially it could be retail where you need to forward pay for stock. You might need to pay 30% deposits, then wait 45 days for the stock to then leave the dock overseas. And all that can be funded. So essentially, you don't need to pay for that off the balance sheet or out of the bank account, and then you get terms. So that lender then will give you terms. So whatever your sales cycle looks like, the lender will give you terms based on that. Could be 60 days, could be 90 days. Some of the lenders even push up to 120 days now, given the current kind of sales cycles of a lot of businesses. So if it's a good, strong, profitable business, some lenders will give you up to 120 days trade finance. So essentially, you are paying an interest repayment rather than coughing up. If it's $1 million worth of stock, instead of coughing up $1 million, you might just be paying an interest based on that. You might be paying it down every 30 days, a portion of it. So there's different kind of finance structures that you can do with that.
And this is very much sort of cash flow financing.
Yeah, that's working capital, yeah, working capital. And then there's term loans as well. So you might want to expand, go get your own office, build a team out, build podcast studio, whatever you need to do. You can get term loans for that kind of debt as well, where, traditional lenders probably wouldn't fund most of it.
Yeah. And what do you, I guess a lot of the clients that we would speak to being in the small business space that have no idea about the funding that they have access to.
Yep.
Obviously, that's a great position for you because, you'd market to them and they're a great client for you. But what needs to be done to, I guess, give these clients more access? Is it just putting your name out there a little bit more? Yeah,
essentially, if they've got the current broker, to ask them about what funding options are out there. It could be, in the current economic environment, it could be an invoice facility. They've become a fair bit more popular over the last few years. Some of your larger kind of clients are probably pushing out, invoice terms. So it could be an invoice facility which can help with working capital. It could be, again, your supply chain, trade finance.
Because talk me through this, right? Because not every broker is the same, though. Right, like you can go and speak to a mortgage broker, and they're probably not going to have this solution for you.
No, exactly right, and that's some of the issues that we see, and probably 20% of what we do is restacking debt, like basically restructuring debt stacks. So they've gone to their mortgage broker, then they might have gone to another broker who's more of a specialist asset finance broker. They've tried to put them into these term loans or supply chain finance facilities, or they've cross-collateralized it with property, and then I've got to sit there and unwind it. And it's not a simple process sometimes. Sometimes it can be a 6-12 month process. You just got to let the founders know that this is what it looks like. We can do this piece now, that piece later.
Yeah.
And it takes time, but then when you get there, the founders can really be set for growth. Then,
But it also sounds like it ingrains you in that client's process, that client's business. So, I mean, I suspect you're going to build a fantastic relationship with these clients because you're the long-term funding partner, right?
Yeah. Yeah, and that's how I try and position myself as a strategic partner. So strategic partner for my clients, strategic partner for lenders as well. So there's a lot of lenders out there, especially in the credit fund space, that may not, really want origination from brokers. There's also some of the non-banks we work with. We can get terms changed. Could be a reduction in rates. Could be going outside policy. Could be removing certain clauses in contracts, removing certain debtors from debtor ledgers, which you need to have good relationships with the lenders to be able to structure those kind of deals.
I think it's very similar to insurance. Our game is insurance. It's all about relationships at the end of the day, which is why I guess dealing with a broker like yourself or a funding partner is going to make so much more sense. One, clients don't have access to going direct in many instances, and also don't have the relationships to unwind some of these things. Talk to me about the type of industries you work with. Naturally, retail is one of those things, but out of interest, do you work with professional service clients, or is it not so much an area of focus because they don't need as much of a sort of the invoice financing, they don't need the cash flow funding?
Yeah, we do service clients. Typically, professional services, it could be, again, moving to a new office, need some fit out, maybe expanding, so they need some working capital, bringing on some staff. There could be some training, might be a bit of a delay before that certain staff member, whether it's sales or operations, starts actually bringing in money to the bottom line. So it can help you with certain loans in those cases. Sector agnostic, really. So we can really do real estate agents, accounting firms. I've done some I've raised some debt to pay off ATO debt for an accounting firm. That's an interesting one. Well, I found that a very interesting kind of funny position, quite ironic. But anyone, obviously you kind of your normal trades, manufacturing. We do a lot in the e-com space as well.
So then take us back to where it is that you began, because you said you started some gyms, then you had a few startups which were sort of ahead of its time. How do you get into finance? Obviously you studied finance, but how did you stumble across getting into funding?
Essentially needed a job that was going to pay me what I was taking out as a wage at my own business when I had the gym. So I kind of beavered around, and there was a couple of options out there. There was selling property off the plan for your big home builders, Metricon, Wisdom Homes, etc. And then I seen an ad for a business manager at a car dealership, essentially. So I went out there and got the job. So I was just doing finance for a car dealership, essentially. Okay. And long story short, got in a bit of an argument on the phone with another broker, fighting over a deal. And then I won that deal, and then he called me up and said, "Oh, mate, you sound like a good broker. Why don't you come work for us?" I said, "No, I got a job." And he goes, "We only work Monday to Friday." I said, "Okay, I'll see you later today." So, just went out, just worked at a kind of a large asset finance brokerage.
Because you were working weekends on dealerships?
Yeah, weekends, dealerships. I was only there for 2 weeks. And, just essentially just went in with that. And then as I was there for about 6 to 9 months, and I was like, what? Like, I was just giving all the commission away. I'm like, why am I sitting here giving? And a lot of the deals are my natural network. I just went out saying, telling people what I did. And I was like, I can go do this on my own. Obviously, had started businesses before, so I wasn't afraid of going out on my own. So I was only there 6 to 9 months, and I went out on my own. And little did I know, I didn't know anything. Like, essentially, I thought I knew so much about finance, and I knew absolutely nothing when I got out. But a lot of my time was spent building relationships with lenders and understanding different finance products, and that's pretty much what got to me to where I am.
It's funny because I can relate to that. When I first started the business, I knew a lot about a little, and I needed to know a lot about a lot, almost. And you kind of have to get your head around various different, in your case, lenders, in my case, insurers, products, because they've all got so many different products, right?
Yeah.
All of their terms will be different. The way they negotiate, what their appetite is all very different. So you kind of need to learn that from scratch. And I think every business owner goes through that, really, whether it's building a website, whether it's marketing your own brand, or whatever it might be. They all have to go through that.
Yeah.
Let's talk about some of the experience that you bring in, naturally, because of that background that you have and a lot of the clients that you deal with. Your clients will rely on you quite a lot for your network, right? And it's not just about funding; it's also about various different aspects of it.
Yeah, you be almost like kind of like a mentor, so almost like a business associate for them, right? Like they bounce a lot of ideas off you. I suppose because you see so many different businesses, could be mum and dad operators, pest control, or it could be huge, 50 mil startups with boards and shareholders and directors and there's so many different moving parts, and because you see all that, you obviously experience so much, and you can start to give little, can't use the word advice, but tips and tricks about what they can do, what you've seen work in the past. The last few years have been pretty interesting. A lot of my kind of bigger clients in the kind of construction space have started to consolidate a lot. Wherever it was before, it was just grow, 30, 40 staff. Now one of them who had over 40 staff is just back down to 8, just really focused on, getting the business right, doing the little things right. Obviously that's been an industry, it's been hit pretty hard. So, sometimes it's not always about growing. It's about, how you can be sustainable long-term.
Yeah, I like that. If I draw a comparison to our industry, insurance is very doom and gloom. Right? It's always about, this is what could negatively happen to your business. Whereas what I like about your industry, it's very much growth focused. And I think a lot of businesses out there don't think about how they can use their debt positively.
Yeah.
How is it that they can use other people's money to propel that growth? It's interesting. I believe later today we're catching up with a client who is running a non-alcoholic brand. Mm-hmm. And they're looking for money because they need various different distribution capabilities, which they can't get without money.
Yeah.
And then what that does is it makes them less competitive with their competitors because they don't have the ability to reduce their unit price.
Mm-hmm.
And all their clients are saying, well, your per unit cost, as in your one can of drink costs so much money for XYZ reason, and they want to shop elsewhere. And it can mean the difference between a business succeeding in the long run or not, right?
Yeah, exactly right. Yeah, and I suppose even touching on that point, the amount of stocks, the amount of capital that have to sit on the balance sheet, the amount you have to have in production and distribution networks, it's very capital intensive, any kind of FMCG product.
Yeah. And so what would you say your number one factor for success would be?
I think being able to be adaptable. The last few years have shown everyone that, you need to be able to adapt to the times. There was a lot of money, a lot of easy money, a lot of free money for a number of years. And I think that people didn't have the right systems, operations set up in place. A lot of businesses grew for the sake of growth. And then when the tides turned a little bit, it showed a lot of problems, a lot of cracks. So I think being able to be adaptable, yeah, that's great. Make those mistakes, but then can you wind that back? Can you go again? Can you consolidate? Can you kind of, rethink your next steps as a business as well?
I've got to echo that, particularly around systems. Businesses can only scale as far as their systems allow them to. Mm. And tell us a little bit about your process. When a client comes to you and says, look, I need to build a new system, whether it's a CRM system, whether it's in whatever it might be, I need to build it. It's going to cost me maybe 50 grand. Do you go out for them on their behalf, or are there instances where there's a bigger raise potentially where you'll take them on a bit of a roadshow? Like how does that differ, and how do you distinguish what that process looks like?
So typically for a kind of funding request of that size, it'd be more of a traditional kind of broker role where I just go out, look for the right lender that matches with the client's need, essentially. I wouldn't really run a full process. Like if it's, if they need 5 mil, 10 mil, they maybe want some equity and there's a bit of debt, maybe it's a bit of a blended piece, then wouldn't really run like a whole data room, but, we'd tell them how to structure it, what to put in there, what we need, and then essentially go out to the market with a bit of a loan summary or synopsis and see who's interested in it.
And in that so was that your full process you were about to describe?
Nah, so the full process. So someone comes to me from day one, say the 50K guy, obviously understand their funding request. So it'll be an initial consultation. From there, we'd get some information. So it'd be like a bit of an information request. Could be financials. I might not need financials if it's only such a small kind of loan request. Need director's details. From there, we kind of look at it. Obviously, from experience, think about where the best position will be, like what lender is going to be best placed for this client. What's the most important factor? Is it term? Is it rate? Is it payout options? So every lender is different. Every lender will have different benefits and different structures. And then, we then essentially just start workshopping the deal, making sure that it doesn't hit credit files, that we workshop it. It's a bit of a longer process doing it like that, but at least then we know we're going to get the right outcome from the client.
Okay. All right. And with the larger type, equity type, do you get involved with those as well?
We do, but we're very selective.
Okay.
One, it has to be a very committed client. Yeah. So we have to be the sole kind of introducer on the deal. And two, it'd have to be something which I believe I'd put money into, because they can be a bit of it can take a lot of time. So if I don't believe it's a business that I would actually invest my money into, then I'm not going to have the kind of incentive. I'm not going to be as excited to get it out there to market.
Yeah, I can imagine it'd be a bit hard to sell, particularly if it's not a business or an industry that you agree with or necessarily believe in.
Yeah, exactly. Yeah, like some of them are just not interested in the business. Could be whatever business or kind of sector it is. It just could be something which, whether I don't quite understand it. Like I can't quite wrap my head around it. How the growth path, like how they're going to realize that growth path. Whereas some other businesses, a lot of them would be that kind of in that consumer space. If I really believe in it, then I'm keen to get my hands dirty and try and raise them some equity.
Now I find this really interesting, right? Like, I guess anyone listening to this is, even before they approach you, they kind of need to get really clear on how they articulate their message, right? If they can't articulate their message in their business and how it is that they market their product or their service, then no one's going to believe in it.
Yeah, exactly. Really. Yeah. And like tacking on to that, they just need to be clear in what they want. And a lot of them are not sure. They might just, I need money. And then that's where my role comes into play as well. I can really kind of unpack that. Okay, well, this is what you need for this. This is what you need for that. Because some clients come to you and say, I need $2 million. Like, what do we need $2 million for here? Yeah. It might not even be $2 million. They might even need $500,000 now and then another $300,000 in 6 months. So it's, they don't need $2 million. They just think they need that. So it's it's important that the businesses really need to have good financial control. I think every business should go see an outsourced CFO, get modelling done. Even if you're a painter with 4 staff, what happens in December, January when everything shuts down, you don't invoice for 6 weeks, right? So you need to have that model there and you need to see where your working capital gaps are going to be. I think it'll be a benefit for any business to have those kind of forecasts, P&L forecasts especially.
That was one of my questions actually. Do you help out with that modelling process or do you have CFOs that you work with?
Yeah, no, we refer it out. We've got a lot of trusted partners that we kind of refer people to for that.
Yeah. Okay. Perfect. And as a percentage of clients that come to you, how many of them would you say are clients who need to get out of a hole, as in that example, and I need $2 million to get out of a hole, or is it versus $2 million, I need to build this thing so that I can, instead of taking it from 20% growth year on year, we're taking it to 50% growth year on year?
I'd say probably 30% is probably the debt restructuring or out of a hole space. Yeah. We are trying to play a little bit more in that space. There's a lot going on at the moment with restructuring SBRs, which is a common theme out there at the moment.
SBR is a small business
restructure, yeah, because you can put, there's pretty favourable funding options out there for them. There's a few lenders now that they've got their heads around them a bit more and they understand them. So typically it's ATO that the people are restructuring, but you may have a 12-month payment plan where you can pay it out, you get a bit of more of a discount, you might be able to do it over 3 years, which helps the kind of cash flow of the business as well.
So it's about 30%, and the remaining 70% is growth focused.
Yeah, mainly growth focused. Yeah, I'd say 70% growth focused, or probably 50% growth focused, 30% that kind of distressed debt, and then 20% of just clients looking to, whether it could be just tack-ons or returning customers, and might not be super growth focused, but might be just replacement of vehicles, might be just changing debtor financiers because the other ones doesn't have a good account management system or something.
Yeah, and you mentioned you're looking to dive into a little bit more the debt restructuring piece because of, I guess, what's going on. Is that specifically the ATO sort of tightening the screws on some ATO debt, or what is it specifically?
Yeah, typically at the moment, what you're seeing is a lot of businesses needing to restructure because of the pressure from the ATO. ATO are kind of the ones forcing their hand. Typically, it's one of the largest debtors as well. So there are different funding options out there available. Typically, the ATO are only giving you 12-month terms for most clients. If you're lucky enough, they'll give you 2 years. I haven't seen a 3-year term for ATO debt for a long time. Essentially, they're trying to clear their decks, from what I've been told. So, if they put people on prolonged payment plans, typically what happens is they pay that down, but then the new ATO kind of debt starts to creep up again. So they really want to try and clear the decks as best as possible. And unfortunately, that also means that, even if you can't afford a 12-month term, they'll almost force your hand into doing a restructure.
Okay. Yeah. And for a lot of clients who may not know what a restructure looks like, what does that look like? Roughly?
Yeah, it could be like whether it's an SBI, if it's the total debt is under $1 million or $1 million worth of liabilities, or it could be an administration. So you go through a deed, DOCA, basically administrators take over the business. You come to a formal arrangement with the creditors, and then that's all agreed on, and you kind of work through that DOCA.
Okay, cool. And what do you think is a key issue in today's business world that you think needs changing?
I think in Australia particularly, I think the SMEs are over-regulated and overtaxed, personally. I think you're kind of penalised from an SME. If you have a look at the way that they're taxed for employing new people, you're essentially penalised for, bringing on new staff with payroll tax. I actually got a business I work with that is trying to, on purpose, keep that below the payroll tax threshold.
Yeah.
Just regulation, red tape. Even though, I get people access to funding, we are very conservative in Australia, whether it's our major banks, whether it's the clients themselves, they get so caught up on interest rates, where you're like, well, yeah, but you're going to make X amount more money. Like, this rate could be whatever it is, but you're going to make so much more, but they just don't quite get their head around it. I think our business, it can be very conservative here in Australia. So the lending's conservative. I think there just needs to be a bit of a shake up in some of the kind of taxation regulation.
Is it almost a mindset thing too from a business owner perspective? Are they expecting 4.5% rates forever?
Yeah,
or something, and
now
we're looking at much higher.
Yeah, exactly. Or a lot of them say I can get 6%. I'm like, yeah, well, that's attached to your mortgage. You know what I mean? Like, you're not getting 6% as a business term loan.
And likely that's just because as a country or as a nation, like we've really been property led, haven't we? Like,
that's it.
Golden years.
We've got property and mining, and that's pretty much it, right? Like, we've got a very strong banking sector as well, but obviously that, the record profits, I think was CBA came out yesterday or something like that, or today. It's the most profitable bank in the world.
Yeah.
So it's they don't need to take risks. Why would they take on further risk and go into the kind of the business sector?
So in your space, are you seeing some growth in small businesses looking for alternative elements of debt?
Yeah, a lot, yeah. And it's becoming more and more prevalent. So, the amount of uptake I've seen in invoice financing in the last 18 months, a lot more clients are open to it. Trade finance, supply chain finance, and then obviously, like I mentioned earlier, I think there's going to be a bit of a rise of these private credit funds over the next 5 to 10 years. I think it's in America, 70% of business funding is via private credit.
Okay.
In Australia, it's below 10%.
Yeah, wow.
So there's a huge market for it.
And that just goes to show, like, what their ecosystem, their startup ecosystem is very different to ours.
Yeah,
naturally.
Yeah.
And I've almost gone blank here. Yeah, interesting. gone blank for the first time ever in the podcast. Anyway, it was about I guess small business and growth and the like. But anyway, we'll go through your vision, I guess, for the future. Talk to me about your vision for the future.
Vision for the future, yes. I hope in the next kind of 3 to 5 years that there is a more robust credit market out there for small businesses. I think we're kind of over the hump. I think that we're probably past peak pain in the market cycle.
That's interesting. I hadn't heard that before.
Yeah, I probably think it's, I'm sure there is still a lot out there, but I think it's past. People have come to terms with what they need to do now. Whether now people over leveraged, so it could be selling down assets or whatever that is. But yeah, I think we're over that kind of peak pain in the cycle personally anyway. That's what I'm seeing out there.
And what that effectively means for people out there is rates coming down, there being a lot more easing up of pressure on families out there. And
yep.
Do you think that then flows on to businesses as well?
Yeah, definitely. Obviously, cheaper money is the more of it there'll be out there. So I think there's forecasts for 3 or 4 rate cuts for the rest of the year. It just helps with sentiment more than anything. But obviously, the way they went up, it was, really did start to affect people's pockets, right? Yeah. So, I think you're seeing that, what's happened in the US, the rest of the world. Obviously, Australia's a very small economy compared to everywhere else, but, we do have a lot of influence from, terms of trade with China. So what happens over there, America, et cetera. So I think the world economy will probably start to turn around and get a bit more steam into it in the next few years.
And what's your vision for your business specifically? Like naturally, Steve, do you have employees or is it just yourself?
Just business partner, Rich, yeah. So I got a new business partner about 18 months ago. Yeah. So he kind of really helped the business evolve. So he's an ex-investment banker, had a few startups on his own, started a fintech. The exited from all them. He's just kind of more come over to Nexus. He's got a lot of connections in the business world, and obviously he's ex-investment banking, so he kind of naturally came to him being able to be a good advisor in that sense. So the business, we don't really want to scale it too much. I mean, the more mouths you have to feed, the more it takes away from what our core value is. We really want to work with clients individually. We want to make sure that we get them the best possible outcome. Like a lot of the times, we shoot ourselves in the foot. We could make a lot more money in certain aspects in different finance products, but we put them into the product that best suits the business. But we think long term, 3, 4, 5, 6 and beyond, that'll play out much better for the business than taking some of the easier short option routes. Yeah,
perfect. And what I was going to ask you earlier was the implications, and I think this is something that business owners or small business owners particularly don't really understand. Now, you mentioned personal guarantee on some instances, particularly the major banks.
Yep.
The options out there, what happens if someone comes to you and asks, maybe it's not 50 grand, maybe it's 100 grand, 250 grand, 500 grand, whatever it might be, 10 million. If there is no personal guarantee, what happens to that business and or that director if they can't pay off that debt?
So essentially the lender will kind of go after the business assets themselves. So it could be, the IP, there's debtor ledgers and stuff in there. So it depends on the type of business, what they've got, if it could be equipment. But essentially it's just, normal business, non-recourse loan, right? The business goes into liquidation or the receivers come in, they try and extract as much value as they can from the business assets. But essentially the director is not personally liable. It's in Australia, in the last 18 months, I heard it more than I did in the last 7 years. But typically most business owners here are just so used to putting up personal guarantees that it doesn't really become an issue. The last 18 months that it's starting to rear its head a little bit, but there are no PG options out there available.
Yeah, okay. Yeah, interesting. I asked that question because obviously, as you know, from a risk perspective, that this is something that we advise clients on quite a bit. And we've always sort of taken a slightly different stance against for directors. The directors can be personally liable at times, depending on the situation. I think that obviously is linked to negligence and misconduct. But naturally, the thing to be very clear on, and the advice or recommendation we've always said, is when you are raising funds or raising debt, being very clear what the purpose is. And I think when a business owner then steers away from what that purpose is, then likely that is when some future liabilities may occur if they steer away from that. And the business doesn't necessarily go as it should.
Yeah.
Would you agree with that?
Yeah, I think so. And obviously, if there's fraud involved or, there's negligence or you haven't really done your fiduciary duty, then obviously I think there's, different covenants and contractual things that come into play. But I suppose from a risk perspective, from an insurance perspective, I know it's getting a little bit tougher out there at the moment for a lot of, trade credit insurance. I know it's a bit tougher. A lot of businesses now dropping off that, so you can't fund a lot of invoices or things with a lot of different businesses now. Yeah,
there's definitely a few implications across the board. Steve, it's been a great conversation. Naturally, we've worked with you over the years, referring some clients to you and vice versa. How do people reach out to you if they want to come and find some finance? Best
spot is probably LinkedIn, Stephen Mitchell at LinkedIn or nexusadvisory.co. Best places to find me.
Great. Steve, thanks for coming on the show.
Thanks, Will.
Socius, thank you for joining us today. Please hit the subscribe button if you've enjoyed this episode. And if you'd like to be part of the Socius community, follow us on Instagram, Facebook, and LinkedIn to stay in touch. Cheers.